Hello everyone, in this video we are going to discuss 51% Bitcoin attack. The agenda is to discuss following topics: introduction to Bitcoin, Bitcoin mining, blockchain, and 51% Bitcoin attack. Before discussing 51% attacks, let us first see what exactly is a Bitcoin. Bitcoin is a cryptocurrency and digital currency system. It is the first decentralized digital currency as it works without a central repository or an administrator. The system is designed in a way that the transactions occur peer to peer, and Bitcoin protocol stores details of every single transaction that occur in a network, and it stores it in a blockchain. The way Bitcoin works is the miners create bitcoins by using computers to solve mathematical functions. This process also verifies previous transactions. Bitcoin exchanges will trade between conventional currencies and Bitcoin, offering a way into the market for non-miners as well as a way to cash out. Businesses create a wallet in the same way as an individual user, typically using a website button payment. For in the flesh enterprises, QR codes can be used to customers pay quickly and easily. Users usually download a Bitcoin wallet that works a little like an email address, providing a way to store and receive currency. Bitcoins can be transferred from one wallet to another using web browser or phone app. So this was all about how Bitcoin works. But where do Bitcoin come from? With paper money, a government decides when to print and distribute money. But as stated earlier, Bitcoin doesn't have a central government. With Bitcoin, miners use special software to solve math problems and are issued a certain number of bitcoins in exchange. This provides a smart way to issue the currency and also creates an incentive for more people to mine. The mining solves two major purposes. It confirms transactions in a trustful manner when enough computational power is devoted to block, and it creates new bitcoins in each block. So the way it works is it has 5 steps. The first step verifies and validates transactions. The second step bundles the transactions into a block. The third step selects header of the most recent block and it inserts into altogether a new block as a hash. And the fourth step solves proof of work problem. The proof of work problem is a method to ensure that the information was difficult to be made. So miners have to solve this problem, and when they get the solution, the new block is added to the local blockchain and propagated to the network. And then a blockchain monitors the issuing of new Bitcoin.
Hello guys, now that you know what Bitcoin is and how Bitcoin mining works, let's now talk about digital trust. So, trust is a risk judgment between different parties, and in the digital world, determining trust often boils down to providing identity, which is authentication, and providing permissions, which is authorization. In the case of blockchain technology, private key cryptography provides a powerful ownership tool that fulfills authentication requirements. Possession of a private key is ownership. It also spares a person from having to share more personal information than they would need for an exchange, leaving them exposed to hackers. Authentication is just not enough. Authorization, having enough money, broadcasting the correct transaction type, etc., needs a distributed peer to peer network as a starting point. A distributed network reduces the risk of centralized corruption or failure. This distributed network must also be committed to the transaction network's recording keeping and security. Authorizing transactions is the result of the entire network applying the rules upon which it was designed, which is like the blockchain's protocol. Authentication and authorization supplied in this way allow for interactions in the digital world without relying on trust. Thus, that is how blockchain technology is often described as the backbone for a transaction layer for the internet, which is the foundation of the internet of the value. Thus, authentication and authorization are vital to digital transactions, which are established as a result of the configuration of blockchain technology. Now, I've been talking about blockchain. So, what is exactly blockchain? So a block consists of number of different transactions together, and then it is sealed by providing digital signature using the hash function, which can be SHA-256. A blockchain is nothing but a transaction database shared by all the nodes participating in a system based on the Bitcoin protocol. A full copy of currency's blockchain contains every transaction ever executed in the currency. With this information, one can find out how much value belonged to each address at any point in history. Every block contains hash of the previous block. This has the effect of creating a chain of blocks from the genesis block to the current block. Each block is guaranteed to come after the previous block chronologically because the previous block hash would otherwise not be known. Each block is also computationally impractical to modify once it has been in the chain for a while because every block after it would have also have to be regenerated. These properties are what makes Bitcoin's transactions irreversible. Thus, the blockchain is the main innovation of Bitcoin. Now, how does blockchain exactly work and how is it highly secure? So, a blockchain is a chain of individual blocks that stores various transactions over a short period of time. For Bitcoin, a new block is created every 10 minutes, so all transactions made within the 10 minutes interval will be part of the block. How can we secure blockchain? In order for the blockchain to be added to the blockchain, miners must compete by racing to solve an extremely difficult and highly computational cryptographic puzzle. The amount of computational energy that is required to complete this task is the cost of participating. The reward for successfully solving the puzzle is some form of payment in the respective cryptocurrency that the blockchain is supporting. So this is how blockchain works. So if you have unconfirmed transactions just like this, for example, David wants to send Sandra 5 BTC, 5 Bitcoins, and there are various people doing the transaction. So in every 10 minutes, this will form a particular block. So it goes to a particular node of the Bitcoin network. As you can see, we have a huge, big Bitcoin network, and there's just one node which will form all group transactions into a particular block. Now, this is what a block is. So the block 149, it will have its own block ID, which would be the hash function value of the block and the previous block's hash function, and it will have all the transactions for that particular time. And every other block is connected to each other in a blockchain. So this is how the blockchain works.
So the nature of blockchain technology has got imaginations running wild because the idea can now be applied to any need for a trustworthy record. And it is also putting the full power of cryptography in the hands of many individuals, which is again stopping digital relationships from requiring a transaction authority for what we usually consider as pull transactions. And just to identify some of the use cases of blockchain, in short, can be categorized as we can see on the slide as one type would be a system of record and the second as a platform. Uh, uh, Generally, cryptographic keys, when they fall in the hands of individuals, they allow them for new ownership rights and a basis to form interesting relationships which are nothing but digital relationships and hence the digital identity. By tokenization, we authenticate a unique physical item, and then many such items are paired with a corresponding digital token, which is nothing but basically used for authentication. This essentially means that tokens are used to bind the physical and digital worlds together. Speaking of the role of blockchain in terms of government or organizational data management, they all have interests in three aspects. Firstly, there's the ownership rights surrounding cryptographic key possession, revocation, replacement, or any sort of loss. Then governments also have an interest in who can act as a part of blockchain network. And along with they're interested in blockchain protocols as they authorize transactions, and they often regulate the transaction authorization through compliance. Yeah. So, a, an example could be stock market regulators, which authorize the format of market exchange trends and trades. Speaking of second kind of use cases as a platform, well, they do share a common agenda, but just to name a few, there would be the role of smart contracting, or for markets where the ways are a little bit different, but they again think of the same cryptocurrency as a digital bearer bond. And again, for streamlining of clearing and settlement, wherein the world of stock trading, we often hear some terms which are followed by some number of days before a particular trade is accepted as and settled. So there are non-blockchain ways to get such numbers down, but without compromising security and risk. So in short, blockchain is definitely changing digital relationships. It's creating the ability for them to be automated in codes. Data is being disclosed differently and secured differently as well. And all of this work is allowing people to get together digitally to establish secure digital relationships, which were pretty much impossible earlier. Moving on to the limitations in the context of blockchain. Of course, there are complexities because the technology itself involves an entirely new vocabulary. It has made cryptography more of a mainstream, but highly specialized industry is chock full of jargon. And since the network size is like pretty huge, blockchain is nothing but set of distributed systems, and they're not much resistant to bad actors as they are anti-fragile. This large network of users is not a very robust network with widely distributed grid of nodes. It becomes more difficult to get the full benefit out of such a network. Again, with size, there comes costs and speed, which are again affected because I mean, like the aspect of using the Bitcoin blockchain not only for transactions but has also been used widely for to store as a storage of information. And so yeah, I think the network speed and then transaction cost both fall under the same hood because of huge network size. And apart from this, there's always scope for human error. It's used as a database wherein the database needs to be of really high quality, and if it is not inherently trustworthy, so the events they need to be recorded accurately in the very first place. And yeah, there are politics involved with blockchain as well, because as it provides an opportunity to digitize the governance models, and then because miners are essentially forming another type of incentivized governance model, there have been ample opportunities for public disagreements between various communities. And then these agreements over the time they change into debates which can turn very technical and sometimes heated, but are informative for those interested in mixture of maybe democracy and they truly support the new technology and the opportunities for governance experimentation that this blockchain technology is opening up. And speaking of debates, speaking of likes and dislikes towards this particular technology, let's move on to some of the attacks and some of the illegal usage of or ill usage of such technology by the community which does not really support Bitcoin or blockchain, or they end up misusing it.
So, after understanding what is blockchain and how it works in Bitcoin, we come to the main topic, that is 51% Bitcoin attack. So, 51% attack is a possible attack existing in the Bitcoin network. So, over here, a person or a person or organization tries to control majority of the mining power. So, by doing this, the attacker has the majority of the power, so it can decide what transaction can be approved or not, or he can try to uh, block the transactions. So what are the effects of 51% attack? So the first is double spending attack. In double spending attack, the attacker tries to retries to do the past transaction, thus spending the same coin multiple times. So this can be a bad side. The second point is that the attacker tries to prevent the other miners from mining valid block. The third point is declining to confirm transactions, trying to block the transaction, the ongoing transaction. So, for example, let's take the double spending attack. So, over here, Alice sends some X amount to Bob and also tries to send the X amount to Charlie. So, the Bob tries to redeem that X amount from the bank, and same the Charlie tries to redeem that amount from redeem the X amount from bank. So, the attacker can try to uh, the 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 attacker can try to do the current transaction again. So in this way, the double spending attack can be performed by the attacker. So how can we prevent this double spending attack? So the bank can delay the transaction confirmation. So this waiting for the confirmation can exponentially decrease the probability of double spending a success. So the prevent so the prevention of 51% attacks is still a severe issue. Hence, we summarized the concepts of blockchain and 51% attack and its possible causes. So, the attacker can misuse some Bitcoin. So, hence, we summarize that we understood the concept of blockchain and 51% attack and its possible causes. So, the usage of Bitcoin has many downsides. The attacker uses Bitcoin for any bad purposes like such as malware attacks. For example, for this would be ransom malware attacks, where any attacker tries to get access to the computer by blocking the keyboard and will ask for some ransom through Bitcoin. Thus, we summarize the Bitcoin and 51% attack.